Welcome to Talk Shop, a commercial real estate finance podcast sponsored by Clear Market. Each episode, we'll bring you real conversations with industry professionals and talk about how deals are getting capitalized with bridge, construction, and equity financing. Our guest today is JC Clemens. JC is the Director of Investments at Flagship Capital Partners, a Houston-based real estate fund focused on debt and limited partner equity investments. Prior to Flagship, JC worked at HFF in both capital markets and investment sales roles. He's a graduate of the University of Texas, where he was a Silver Spur handler for Bevo, their beloved Longhorn mascot. We had a great conversation, and I hope you enjoy it. JCC, thank you for joining us. Excited to get into it here and talk about what you're doing at Flagship. But to start us out, let's kind of get a little bit of background, a little bit of context on you and on what's your story.
Yeah, no, thanks for having me on and appreciate taking the time. Background on me, graduated from UT, I guess it was 2011, started work at HFF about 2 weeks after graduating, was in kind of the mortgage banking analyst pool for about 3.5 years, which was a great place to, cut my teeth on, working on, dozens of transactions every month and, working on different types of deals all across the country. And then after about 3.5 years, that analyst program is you either kind of, jump up or jump out. And so I was lucky enough to kind of jump up into production. I actually transitioned from the mortgage banking side of the business over to the multifamily investment sales side. There was a team in Houston that had come over from CB that was very well established. And so I headed up their B&C multifamily sales platform. I did that from, I think, end of 2013 up until the end of 2016. And that's whenever I wanted to get out of the brokerage side of the business and make a transition. And so at that point, I didn't know if I wanted to go into development or start buying my own deals and get onto the GP side, or if I wanted to get onto the lending side. And then I landed at Flagship as an originator for their initial, not their initial debt fund, it was debt fund 4, but really just putting together bridge loans out of their fund. And since then, it's been almost 4 years, and we grew Debt Fund 4 from $50 million to $125 million and closed out that fund in November of last year with a couple loans, one in New Braunfels and one in Tulsa. And then we quickly raised another debt fund, and so now we have another $125 million debt fund, and we closed our first deal in Fort Smith, Arkansas, in December, and we've got a handful of deals lined up now. And so that's the debt side of the business at Flagship, where I run originations for kind of Texas and the surrounding states, which is our main focus. And then the other side of the coin is, ever since I've been here at Flagship, we've run somewhat like a family office, syndicating equity for multifamily and other commercial type transactions. Did about $50 million on a deal by deal basis, where, somebody would come in into one of my principals or myself and say, I'm buying a $20 million apartment complex. I need $5 million in equity. Us in the office, we'd put together $2 or $3 million, and then we'd call a couple of friends and round out the stack. And that process can be pretty cumbersome for those who are out there that raise equity on a deal by deal basis. It's a complete pain. And so we went kind of towards the other side of that and went out and raised a formal fund as a fiduciary for our kind of partners capital, raised $50 million. We closed the fund in January of 2020. We closed our first deal a few days before COVID hit, and then we continued to close transactions throughout the rest of last year. We closed 5 deals, 4 multis and 1 office building. And then we closed a deal in Phoenix about 4 weeks ago, and we've got LOIs out executed on 3 more deals, one in a suburb of Portland, one in Atlanta, and then another one in Dallas, and hopefully got some other ones in the Carolinas and in Texas coming up. And so the real basis of the equity fund is to focus on multifamily value add LP investment opportunities all across the country. And we are also investing in some select office building transactions as well, probably 75% multifamily, 25% other commercial types with a heavy hand on office. And we're 3 to 5 year investors. We come in as an LP, pari passu to all other monies in the deal. And we're looking for mid-teens plus net IRRs on our money. And we've got full discretion of our capital, which is a nice thing at Flagship, is we don't have some large committee. The 2 principals are here in my office. I run originations for both the debt and the equity platforms. And it's a lot of time on planes, trains, and automobiles. But it's been a good experience over the past 4 years, and we're growing our capital and looking for new opportunities both on the debt and equity side.
Awesome. Yeah, you've been very active in the space, and I'm excited to get into kind of how you structure your deals and maybe talk through an example. But before we do that, I want to jump back on to the Silver Spurs. I went out to a USC game or UT USC game a couple of years ago and saw that whole ordeal in person, and it's wild. What was that like? How did you get into doing that?
Yeah, so interesting deal. So being from Amarillo, I grew up, around livestock and had a lot of friends that were very active in 4-H and other kind of animal showing activities. And so I am comfortable around, livestock and other animals, and went to school at UT. And there was an opportunity for me to join that organization through the fraternity that I was in. And then kind of the natural progression is, get the redneck from Amarillo to take care of the steer. And so ended up really falling in love, one, with the animal, and two, the Bakers, who were the owners of Bevo. And just it's really a breath of fresh air to be around people that are involved in livestock and 4-H, and raising animals to help raise funds for kids to go to college is still a very important part of my life. I'm a 10-year committeeman of the Houston Livestock Show and Rodeo, and I'll actually be out there next week. Even though the main rodeo got canceled, we're still going out there and helping kids get their animals showed so that they can auction them off and raise funds for college. And so the passion kind of started while my friends were doing it in high school, and then you go to college and get the opportunity, and it was a lot of work. I'm not going to lie. We had to be at the ranch about 6 hours before each game. So on a noon start, that's an early morning for a college kid. But we'd go out to the ranch, 3 or 4 days a week and go tend to the animal, make sure everything was ready to go. And then we would travel with them all across the country and take them to all the different games. And there's a large network of kind of alumni in our organization that have ranches pretty much near every major city. And so when Bevo actually went out, I was at the national championship whenever we were out at the Rose Bowl. I wasn't a handler, but my buddies were. They found ranches.
That game.
Yeah. So they found ranches all the way from Austin, El Paso, Las Vegas, and then Southern California to hold the animal while they were going out there. And so pretty really fun deal. And, something that, at some point I need to pull it off my resume, but it's always a good kind of conversation piece to talk to people about. So it was a great experience.
That's awesome. Good on you. I've seen, that's a big animal. I wouldn't do it. So that's a very cool tradition. And thanks for sharing. Kind of shifting gears back to Flagship, maybe talk us through, what does the typical sponsor, that you work with look like, and, what kind of deals are they doing, and how are they being structured?
Yeah. So, I always tell people that we're not going to do somebody's first deal. I think there's a different type of capital for every type of sponsor out there. And so if it's somebody really kind of doing their first syndication deal, or really just trying to get into real estate that's leaving some other type of industry, probably not a good fit for Flagship. But we are willing to do people's, second and third deal. So for us, it's somebody who's gone full cycle on one transaction, and somebody that is entrepreneurial in the fact that we like to do multiple deals with the same sponsor. Because in a business like ours, you're trying to cut down your time spent out there seeking new sponsors. So the hardest thing for me to do is to call around to every broker, and every broker call me to try and find, the good people buying the good deals. It's typically not the other way around. It's not the bad people finding the good deals. And so we're extremely sponsorship driven here at Flagship. And so I typically tell people in between kind of deals 2 and 15 is where we catch a lot of our borrowers on the debt side. Just because once people kind of get into the larger institutional type world, they'll have direct relationships and kind of a ongoing agreement with a certain lender so that they can really kind of scale up. Somebody who has in-house management is something that we like. Typically, if it's a value add group, we really like them to have their own construction company, just because we've learned from the GP side, which is where Flagship came from. The 2 principals in my office owned about 30,000 units from the early 90s to the early 2000s. And so we understand the GP side of this business and have owned construction companies and management companies. And it helps take out one more kind of link in the chain so that the sponsors can really keep an eye on their project. So we like people that are vertically integrated. We like the people to live nearby where their deals are. I can't tell you how many times I've got guys from California that are buying deals in Houston, and they just see a cap rate and they think that they can come in and operate this deal. And if you don't know the submarket and the demographic of your tenant, it's tough. And so if somebody's not living in the market where they're doing the deal, we like them to be there, once every 3 weeks or so. And so that's really important to us. And then sponsors having money invested in the deal is also very important to us. We mandate on the debt side that the sponsor has 10% net equity in the deal themselves personally. So if it's a $7 million equity check to get the deal taken down, we need them to have $700K in the deal. And that's net of any acquisition fee. That's net of, any other fees that they're going to be taking at closing, because we'd like to have alignment of interest in these deals because, we're a debt fund that keeps everything on our balance sheet. And a lot of the money that's coming out of our debt fund is our own personal capital here in the office. And so we don't think it's too much to ask to have a sponsor with interests that are aligned with ours by having actual skin in the game. So that's important for us on the debt side. And obviously, anybody who's got any bankruptcies or anything in their histories, for how long that you've been in this business, that you're probably going to have a skid mark or two. And so I think that as long as there's a good explanation and people can tell us, what happened in '07, and as long as we can make some phone calls and understand that they operated ethically through that bad time for a lot of real estate guys, that we can get over it. But we do conduct extensive background checks and make sure that everybody's credit's good and all their previous, borrowing activities have been ethical. And so really, we like to see people with some experience, somebody who's got some skin in the game. Net worth and liquidity requirements are something that we can work with. Typically, I like liquidity, cash or cash equivalents, equal to 1 year's debt service. And I like to have, a net worth at or above the loan amount. And really just talking to people and getting to know them beforehand. Our courtship is pretty heavy on the front end with our sponsors. But once you're kind of in a deal with us, it tends to be a very, very fluid process because we're not a lender by trade. We're owners of real estate by trade. And so we really get that if something goes wrong in the budget, you can contact us. And as long as you're transparent, we can probably work with you and move some things around. We're not in the business of trying to string up borrowers or take assets back. We've lended, I think, upwards of $425 million in $2 to $15 million loan amounts on these bridge debt funds of ours, and we've never taken a deal back. And so I think that's, Wall Street would say that we're not pushing the risk curve hard enough, but we're just really not in the business of taking assets back, because while that sounds sexy to somebody who doesn't know it or somebody who hasn't done it before, it's really just kind of a pain in the ass, and you don't make a lot of money doing it. And typically it's just not a good situation for both parties. And so that's something that we really don't like to do.
Yeah, you're in the business of building partnerships. And so to kind of sum up what you just said, I guess, to start developing a partnership with Flagship, you've got to, have a little bit of experience, 1 or 2 deals under your belt, some skin in the game, some boots on the ground operations, hopefully, and be a good person. So when should people reach out? Is it when they're under contract or before that, or, there's a fine line between, spinning wheels and being conscious of your time and having that relationship set up, before it's go time. So when do you like to hear from people?
Yeah. So on the debt side, it really, I think the earlier the better, just because truing up the debt, it's the chicken and the egg, right? It's like, well, you have to get the equity to get the debt. You have to get the debt to get the equity. And so we understand that. Again, we've bought and sold a lot of transactions before. So typically whenever I like to see the underwriting and stuff come across my desk is whenever somebody hasn't agreed upon, contract price. You can still be kind of nitpicking the PSA and not have the deal truly under contract. But if you've submitted a bid, probably not worth my time to really go full bore on the underwriting. But if you're close and you think you're pretty close to kind of, getting the deal, then I'm happy to underwrite it, get some initial feedback to you. On the equity side, typically, we can fund equity transactions faster than we can fund debt transactions, just because of obviously all the reporting and all the documentation that's involved, especially coming in as an LP on the The equity side, typically we can close those transactions in 3 weeks after executing an LOI. On the debt side, we transact in under 30 days after an executed LOI. And so on the equity side, you can come a little bit later, but I'm a big proponent of getting deals in sooner rather than later. And if it's a no, I can tell you a quick no, and you can kind of go down the road and get your deal closed. But if it's a yes, I should be able to get some initial feedback to you, 24, 48 hours on, hey, we're interested. This is ballpark where we would be. Here's our list of questions. And if you get those answered, we'd like to set up a call with you and the sponsor, if it's coming from a broker or directly with the sponsor. And our process thereafter is, after we have that initial call and it goes well, we typically, both on the debt and equity side, email kind of a bullet outline of terms that, is loan amount or investment amount. On the debt side, it'll be rate, term, minimum interest, timeline, exit fees, everything like that. On the equity side, it'll be investment amount, pref, waterfall, any other, things that we think are high level business points that we need to kind of jump in front of. And if the sponsor and or the broker say, hey, we're close, then we'll get a term sheet to you both on the debt or equity side within 48 hours. And once that term sheet is negotiated and executed, we require a deposit for both our debt and our equity side. And I'm typically on a plane to come see you, meet at the property. And then if everything goes well after that initial deal, we're going to docs and we're closing two to 3 weeks later, depending on the third parties on the debt side or depending on just the timeline of the closing for the debt to be secured on the equity side.
Great. So, you got an efficient process for both the debt and the equity side of it. Is it possible, can we talk through maybe a recent deal and the structure of it? I mean, I don't want you to divulge any specifics, but something to give our listeners some context.
Yeah. So we just sent out a blast not too long ago, like 15 minutes ago, 4 recent closings that we had. On the debt side, I'll go over a deal that we did in Central Texas. So this was a group out of Aspen that I know well. That acquires multifamily deals. They've got a big portfolio in Central Texas, and they bought a bunch of stuff in El Paso recently. They own some deals in Colorado and New Mexico as well. But it was a 100+ unit deal in kind of the New Braunfels area, and they came to us and they were requesting 75% of cost on that deal. I think they were buying it for $75 a door type thing and going to put $6,000 to $8,000 into it. And we found out throughout the process that there was a large easement from an adjoining property owner that was in the property. And so this will kind of give you some insight into Flagship's ability to be nimble. So we ended up figuring out a way to get around the easement issue by having to kind of get back in a relationship with the adjoining property owner, because the adjoining property owner despised the seller and wanted to do everything possible to sabotage the sale of the deal. So we really kind of had to play some old school real estate games to get in contact with them, let them know that we're going to be the new lender and the owner was going to be the new owner, and got an agreed upon purchase kind of buyout of that easement, finished by closing. And then also there was a active water event, hurricane in the Gulf. And so at the day before closing, we couldn't buy into insurance. So we had to push that another week, but ended up getting that deal closed at 75% of cost. I think we funded everything that we needed to at closing, held back about $800,000, which is about $8,000 a unit to finish the renovation. And interest rate on that deal was, I think, 5.75 or 6%, point in, point out type loan. And initial term was 24 months with 2 1-year extensions. And I had a call with the sponsor the other day, and they're going to pay us off at 12 months in a day. Which is we have a minimum interest requirement of 12 months. So you can pay us off at any time, but if you pay us off at month 9, you need to pay for those 3 months and then pay the exit fee. They're going to wait until the end of that 12-month period, and they've already executed their business plan, drastically increased rents, and we're going to be out of that deal, 12 to probably 15 months. And so that's a good example of loan that we've done on the debt side. On the equity side, you talk about a deal that we did in Phoenix. That was a 3-property deal that actually another guy out of Denver that I know was introduced to us through a broker who's a good friend of mine, an ex-HFF guy in Newport Beach. And so he hooked us up with client who already owned a deal in Phoenix, had done very well. They were buying the deal for, call it low 120s a door for 1980s vintage Phoenix product, which is pretty unheard of right now. It was kind of at a 4.5 to 4.75 cap, which value add deals in Phoenix are trading at 3.5 to 3.75 caps right now. So we felt very comfortable about the going in basis, the going in yield. His business plan was to put washers and dryers in the units and value add, on select units. Some had been renovated and some had been not. And so that was a deal that we closed. I think it was 15 business days after having an executed LOI. I think our investment amount was $4 million in that deal. Total equity for that transaction, I think, was 7.5. So he had some friends and family that rounded out the rest of the stack. And he personally had about $1 million in the deal. And the deal that we had on that one, I think that was a 9 pref, 75-25 to a 17, and then a 60-40 thereafter. And I think we got, a point or two on our money. And that was kind of that. The other equity partners in the deal liked our negotiated kind of waterfall and structure, and the sponsor was okay with it. And so typically on these deals, if we're not the sole LP, if there's an LP group that's got, 60% of the equity in the deal, they're typically going to negotiate the terms, and we come in and accept those terms. And if we need to accept any differences on, we need something different than the other LPs, then we just kind of conduct that in a side letter or discuss with the other LP to see if they want to change their deal to match what makes us whole. That's an example of 2 transactions that we've done recently, both on the debt and equity side, that are pretty bread and butter for us. And, we'd like to do 10 or 15 more of those this year.
Great. On that Phoenix deal, you mentioned you liked your basis going in, and you kind of are solving for a certain IRR across the entire project. Can you maybe give us some insight into your underwriting philosophy, and maybe where you see some sponsors go wrong, and there's people don't see eye to eye on maybe how you evaluate rent or expense growth, or just certain underwriting assumptions that there's some push and pull on?
Yeah. So I think the biggest mistake that people are making, on value add deals now, and especially a lot of syndicators that are out there, they're really pumping these things for online funding and such, is that, the story of just blindly putting in, $5,000 to $10,000 a unit and getting $100 to $150 rent increases is just not true. It's so specific to what's going on in the market. Like Houston, for example, I have friends that have, 3,000 to 5,000 units that they own here, and they've all stopped renovating just because they're just not getting it. It's just a fact. And, but there's other markets, for example, our Phoenix deal, we underwrote $300 rent increases on that 8K deal, which is a pretty hefty return for not spending a ton of money on a unit. But he went in that deal, he just leased a unit that used to rent for $700 for $1,200. And so, damn near doubled the rent. And so it's really market driven, and you really have to prove that up. So I think the biggest thing that I really pull back on the underwriting is how much you're putting in and how much rent increases you plan on getting out of it. I'm super realistic on what can be achieved and what's being achieved at other properties nearby. So that's probably the first thing. I mean, rent growth, just generic rent growth, it's very market driven. I mean, Houston, it's going backwards. Dallas, it's slow. Austin, it's flat. But if you read the headlines for Austin and Dallas, you think that rent would be growing at 6% annualized, but it's just not. And so if somebody's just blindly putting in 3% and 2.5% expense growth, then I'm probably not going to do that. Typically what I like to do is really give a little bit of credit just for market generated rent growth, maybe 1% to 2%, maybe. But really, I just like to underwrite the value add kind of rent increases in the deal, and then I'll grow it at 1% to 2% past that. Expense growth, call it what you want, 2%, 3%, really not that big of a deal to me. Taxes are the biggest thing for me on the expenses. I can't not tell you how many deals in Texas that have just gotten crucified on the tax front, and there's nothing you can do about it. So being a non-disclosure state, you historically have been able to get away with underwriting anywhere from 50 to 70% of purchase price on your taxes. Now it's looking more like 100 to 110% of purchase, and you're having to spend money on litigation to get it back down to where you're walking in with the closing statement at the courthouse saying, this is what I paid for the deal, just to get back to normal. So that's obviously a Texas issue. Phoenix, that's not an issue. Our deal in Portland, that's not an issue. So really taxes and doing a deep tax analysis, because that's obviously that and insurance are the biggest line items that you've got on your expense side. So that's really big for me. And then just cap rate kind of assumptions. So I did an analysis on our Portland deal, which was surprising to me. I said, all right, so deals are trading at Portland cap rates are kind of the same as Phoenix. Value add deals are 3.5% to 4%, which is just crazy, but it is what it is. That's kind of the price of playing poker up there. And so I did a historical analysis saying, well, that's where cap rates are today when interest rates are at zero or whatever, depending on what index you're looking at. But what if, LIBOR, which is kind of going away, but what if SOFR goes up, or what if the Treasury, where was the 10-year Treasury yield when, where cap rates, if the 10-year was at 2.5%, where cap rates still 3.5% on value add. And in the Pacific Northwest and other major markets, it was, but in Texas, it was not. So for me, on where interest rates are today, I'm underwriting a little bit of cap rate expansion on a lot of deals. And it's interesting because some of these syndicators and other sponsors, frankly, are underwriting cap rate compression, which is just unbelievable to me. And so on a Texas deal that we've done recently, the going in cap rate was a little over a 5. I put an exit at a 5.75 or a 6 just to be conservative. And our numbers still made sense. I think that deal trades inside of that all day on a cap rate scale. But I just think if interest rates move, cap rates cannot stay the same in kind of southern markets. It's just not going to work. And so because the numbers aren't going to work and the capital doesn't drive to southern markets like it does to other kind of, Pacific markets or, coastal markets. And so I think really cap rate reality is something that I really like to see on underwriting. So if somebody's buying a deal at a 4.5 and they're taking it to a 5.25 on the exit, that feels good. There's no specific delta that I need to see. It's really just kind of how does that cap rate, look on an exit if interest rates go up. And to that point, also refinance assumptions. I highly doubt that Freddie's going to be lending out money at 3%, at 75% in 4 years. I just don't believe it. So refinance assumptions are something that I really do push back on also, because that's a big IRR factor, because if you're returning capital midway through the project, that has a high impact on the IRR, obviously. And so I get pretty, I'm not over the top conservative, but I'm very realistic on refinance assumptions, exit cap rates. And at the end of the day, some of these things you really have to think of them on a price per pound. So in Houston, I don't think that investors are going to be willing to pay $120K a door for 1980s vintage product. I just don't think that they're going to be able to stomach that in 3 to 5 years. I think that low 100s make sense, but at some point, buyers in southern markets, central, southwest, Texas, southeast, they are going to get, there's just going to be kind of a sticker shock on some of these things on the exit. And unless everything is going perfect, I just don't see capital being like, all right, I'm going to pay $150 a door for a 1970s vintage deal in Dallas. If it was in Oakland or San Francisco all day, that's probably more like $350 a door. But, I think that it's kind of an art, not a science, trying to figure out the cap rate per unit, kind of combo on the exit, because for us as investors, I got to think of who buys this deal and how are they going to look at it, because they have to walk into an investment committee also. And so are they going to walk in and say, hey, this deal's a 5.25 cap at, 102 a door? That would sound okay to me in a few years. But if somebody walked into my office and said, an analyst or, one of the associates here comes in and says, hey, I've got a 4 cap in Houston that's 145 a unit, the deal makes a 20 IRR, I'm going to say, no, it doesn't. And so you got to be kind of cognizant of who's buying these deals and what the capital is going to be looking for on the tail end.
Right. So very kind of cognizant of what's going on in the greater, fixed income markets and what's, because right now a lot of that's driving cap rates down as people come into real estate. But if they can find yield elsewhere, that's going to affect the tail end of your investment.
Yep.
So kind of moving into, I guess kind of a current event topic, or just a hot topic right now. There's kind of a few philosophies on asset classes, and let's keep it with multifamily. What's your take on kind of Class A versus the lower tier assets?
Yeah, it's a great question. I mean, we talk about it all the time because as we're raising these new funds, we got to figure out kind of what our focus is going to be. And I think that for us, until there's any major distressed opportunities, not anything like we saw in COVID, which was 5 to 10% maybe on multis. I think that the workforce housing space is the only space that we want to play in for several reasons. I think one, at the end of the day, there's a government subsidized lending platform that is Freddie and Fannie that are always going to lend at the cheapest possible rate on that until something changes on the political stage. And I don't foresee that happening even with the current administration. So that's one. Two, it's very simple supply and demand for us. Workforce housing is not accretive to build because you can't get the rents. You cannot build affordable housing. Or workforce housing. You can build affordable if it classifies as affordable, but again, that's subsidized by the government. So for us, there's always going to be people that have a necessity to live in the workforce housing type units, and you can't build it anymore. So for us, it's very simple supply and demand. And then kind of point three.
And sorry to interject. Just for our listeners there, that's kind of a function of replacement cost, and then not being able to put up a competing building on the vacant lot next door, right?
Yeah, correct. I mean, land's too expensive, and so if you could charge $1,400 a month, then you could do that. But if you charge $700 a month, then it costs you, to build a brand new Class A deal in Houston, it's 4-story wrap deal, it's $240 a unit. They have to get $1,800 to $2,000 rents to make that thing pencil. To build a 3-story garden style deal that is workforcey kind of deal, call it's $170 to $180 a door, and you still need to get kind of $1,200 rents to make that thing pencil. And so there's really not, you can't go build these things for $100 a unit, and that's what value add deals are saying they're going to trade for on the exit. So it's really just it's not cost prohibitive to build new workforce housing out there in the market, especially in more dense markets like California, in New York, and others.
Mm-hmm.
And then, I really just think that on kind of the risk-adjusted return scale, right? So when things go really bad, people move from the high-rise to the 4-story. And people that used to live in the 4-story move from the 4-story to the 2-story. And people that live in the 2-story move to the 1-story. And the people that live in the 1-story move to the 1-story to the 1-story to the 1-story. I mean, so people move down. And that is, from a risk standpoint, something that we like. So when the market crashes, people don't move into nicer places. And so for us, it's all about risk-adjusted return, right? So we think that if we can make a 15% return on something, and in a terrible Armageddon type scenario, that 15 goes to a 6, that feels pretty good. But in the Class A space, you're not going to be getting much higher, probably lower from a return standpoint if you invest in those deals, and your risk is substantially higher because there's a decent chance that deal could go back to the lender and you could be completely wiped out. And so for us, on a risk-adjusted basis, the workforce housing is really all that we want to be in. Simply supply and demand. The financing is always going to be available for those type of projects. And on the risk-adjusted kind of scale of different types of real estate, sure, it's really hard to make a 30, but making low double digits to mid double digits on those type things, if you're buying them right and working them right and financing them correctly, it's a pretty good risk-adjusted return, we feel like, compared to other asset classes.
Mm-hmm. Yeah. So next question is kind of, tell us about a war story, maybe a deal that, didn't go as planned, or, tell us, if you don't mind sharing.
Yeah. So I'm trying to think, I've always been, this is kind of on the lending side, which is interesting. It really kind of shows the true stripes of, CLO and CMBS guys on Wall Street. It shows you how much they care about originating your loan. So I was doing a loan origination on a shopping center, Northwest Houston. I think it was in 2014. Had a bank on the end cap. It was a 150,000 square foot deal up in Kingwood. And the originator, some CMBS guy at, one of the sketchy shops, that every shop is sketchy on the CMBS side, but they just changed their names over the years. And so this guy flew in on a Tuesday and we were doing a full 75%, 4.5% rate deal to take pictures and get ready to get the deal securitized so that we could close and then he could sell the note after. That Saturday, not really the real estate's fault. It was a good area, but that there was a smack, like a car ran into the bank on the side. 2 people were murdered, bank robbery, the whole thing. Us as an ethical broker called the syndicator on his cell phone and said, hey, there was a robbery, everything like that. And he goes, is it in the papers yet? And we were like, I don't think so. The owner just called and told us. And this was on a Tuesday, I think. And he said, great, let me know whenever it gets in the papers the second that you hear. And he securitized the deal and sold the paper, X amount of days later. And then we sent him the article and he just responded. He goes, yeah, already taken care of. Don't worry about it. Kind of deal. So he just wanted to know that if his B-piece buyer was going to be able to figure out if that had happened on the property in time. And he didn't care because he had already sold the paper. So that was just kind of an interesting eye opener for me earlier in my career. And which is why, again, I like Flagship because we're balance sheet lenders because we live with these loans because there's a lot of people out there that don't live with these loans. We have a lot of borrowers a lot of equity clients too, that whenever they ask us who should we do the loan with, we say always go with a balance sheet bridge lender for that exact reason, because you don't want to get caught with the servicer and have to deal with all that. So that was an interesting one. And unfortunately that was CMBS 2.0 and now we're in CMBS 4.0 and the game hasn't changed one bit.
Yeah, it's unfortunate. There is a lot of misalignment of interest out there, and it really, first of all, you got to make sure the people you're working with are ethical and good people, and then it helps when everything's aligned in a shop like yours where your balance sheet, and even beyond that, there's other benefits to working with a balance sheet lender that you mentioned a few of them, but just knowing who you can talk to and when you need to work something out. So let's end it on a high note here. Tell us about your best deal. What maybe, best transaction or deal you've done?
Yeah. So nobody really ever asked about that. I'm trying to think. Oh, there's a good one. So we recently exited outside of our equity fund, but a good example of the type of deal that we would invest in our equity fund. This deal was a 274 kind of manufactured home community in Northwest Houston. So went in on the deal. So it's literally like off the truck, put it down, 2, 3, 4 bedrooms adjacent to a nice master plan community type deal. And it was rent by the little home type deal. I think our guy went in at the transaction, bought it from a guy who had kind of developed it, but really didn't know what he was doing. And he wanted to get back to developing real lots and everything like that. So I think we went in on the deal. I think the purchase price was, $14 million for that. Was in it for 3.5 years, had bank debt on it at like 4.5%. And then it just transacted before the end of the year at a $21 million sale on a 3-year hold. And it netted to the investors after the promote to the sponsor, like a 37 IRR or something like that to us and our partners. And so kind of a different asset class, something that we thought we were going to make 13% on, but the market really kind of, drove up. And I think the SFR market is something that we would like to kind of get more into because this is a great example of how it worked out. But, something that we really thought the deal was going to exit on kind of a 7.25 cap just because it was manufactured housing kind of thing. And it traded at a 4.75 cap. And so that helps the numbers, obviously. And so
yeah,
it was good cash flow going in. It's one of the few times that, it just worked out without us acting smart, just getting lucky. And I think that just shows you a good way that it can turn. But also I was talking to my boss, David, about this the other day. He's been in transactions where it's gone the other way. And that's, back in the 80s and early 90s in the Enron time down here in Houston, or in the 80s, the oil crash then, or in 2007, 2008, when people were buying deals on 4 caps. And then the only way that they could exit the deal was saying, hey, this is a 7 yield. you come by it at a 7 yield. And that obviously will crush your numbers. And so that was a good reminder that, the barn door swings both ways.
It's better to be lucky than smart sometimes.
Absolutely. Absolutely.
Yeah. Okay. Awesome. Well, really appreciate you joining us here, and we'll get this out to our listeners. And thanks again, JCC. Well, if people listening want to reach you, how can they? What's the best way for them to get in touch and kind of start developing sponsors out there that want to maybe work with Flagship?
I mean, my first response would be to call you, because we do kind of lean heavily on our brokerage community out there to help us vet deals. It's just, for as lean as a shop as we are, we really like to have kind of advisors and friends out there that can help kind of pre-screen and, help us do that. But if anybody wants to reach out to me direct and ask questions on markets that we like, prior deals that we've closed, all my information's on the website, my cell phone, and office line and email. So feel free to reach out at any time. Happy to answer any questions about our program, any deals that we've closed, past or present, and kind of what we're looking to do. But I really do, work a lot with brokers and tend to go that route. So either however you want to get to me, you can get to me.